We've got 40 minutes to have a two-way discussion is what we're hoping, a question and answer type session. I was expecting a much smaller room, so I was hoping it was going to be more intimate, but we'll be as intimate as we can. Introduce ourselves real quick. I'm Joe Morris, this is Peyton Green. We run the investment and acquisition activities at a local venture capital company called Traction Capital. That's the last time you'll hear that name because we're not promoting Traction Capital, it's just who we are and where we're from. I've been in the startup industry for almost 40 years now. I'm a private investor, I'm an angel investor, been a member of Gopher Angels since it began. I've been a Techstars mentor for a number of years, and now I'm working part-time with the venture capital company. So our discussion today is about different ways to fund your startup. Friends and family, angel investor, venture capital, the ins and outs of it. Everything you'll hear today is basically our opinions of having gone through all of that ourselves. So it's advice, it's opinions. Nothing is absolutely factual. It's that kind of environment when you go for your startup and funding your startup. So we did want to ask a little bit about all of you. How many are thinking of starting a startup? One. How many of you, or two, sorry, okay. Three. How many of you have a startup? Good, awesome. Welcome to HELL. How many of you have funded a startup already? How many of you are looking for funding? Awesome, okay. And those who have funded or looking for funding, are you looking at friends and family right now? Looking for angel investors? Looking for professional money? Cool, okay. Well, we will focus where you want us to focus. So feel free to ask questions whenever you want. Interrupt me, raise hand, interrupt me, we'll stop. And we lost it again? So one of the things we want to talk about is our view of what some of the differences are in those three categories. You know, we'll start talking about friends and family because that's usually where you start. Then we'll talk about angel investors and we'll talk about venture capital or professional money. We lost our laptop.
It's flashing at me a whole bunch here.
It's flashing at us. So, so let's talk about friends and family while they're fixing that. So, in our view, there's three types. I have two on the slide, but three types of friends and family where you can raise money from. One is, good old Uncle Charlie, who's had his business, maybe sold it, has some money, looking for different ways to do things, and he's your uncle. So he has interest in you as an individual. Friends and families, that's what they focus on. They don't necessarily focus on the business, they don't necessarily focus on the market or the TAM or anything else, which we'll talk about. They focus on you as the individual, and they have a personal desire to help you as an individual. So you've got, Uncle Charlie, who if he wants to give you 25 grand, 50 grand, it's discretionary money, he probably doesn't know what to do with it anyway. And, in long term, the pressure on you as the entrepreneur to perform is not all that great. Now you talk about mom and dad, right, who have worked hard all their lives, supported you, sent you to school, maybe have a nice retirement egg, and for them to give you 25 grand, it's not necessarily discretionary money, right? It's taking away retirement money. So what happens is you as an entrepreneur, as you go through your venture, that becomes a lot of pressure because you do not want to default or fail on mom and dad's 25 grand because you know the effect on them. Another one, Peyton, do you want me to talk about while you're fixing that? Or?
Yeah, I'm a little preoccupied.
Okay, all right. is borrowing from a friend's father. Another, huh?
I'm recycling.
You're recycling, okay. Another type of pressure. You know, and so, as you know, and I wish I had my slides to prompt me on all this, so I apologize. I'm trying to do it from rote. As you know, and I hate to say this, but a lot of startups fail, or they struggle and then they pivot. You know, both those activities make it hard to pay back the investment from friends and family. So be very conscious when you borrow money or have your friends and family invest that there's going to be a lot of personal pressure on you to perform and get that money back because it is a personal relationship. That pressure lessens as you get more and more up the investment chain, right? As you get into angel investors and into professional money. The other thing, and I talked about the focus of friends and family is you. It's not necessarily your business. They're not going to go out and do market research. They're not going to look at competition. They're not going to look at total addressable markets, anything like that. They're investing in you, right? And that's where that pressure comes from.
How do you recommend handling expectations with that conversation?
Make sure they understand that the money may not turn into anything. Make sure you vet that as hard as you can. You know, that's the best way to do it. Set their expectations that 90% of the time, they're not going to get their money back, right? Right? Even though you believe in it 100%, you do. As an entrepreneur, you better believe in what you're doing 100%, 110%. But there's a good chance they will not get it back, right? Make sure they know that. The other thing, part of the discussion, the investment discussion, that's typical with friends and family and gets less typical as you move up the chain, is it's all about a percentage of ownership, right? They don't talk about valuation of the company, valuation of the business, and to get to a percentage that way. The whole discussion is usually around, oh, for 25 grand, I'll give you 10% of the company. That's usually the discussion. It's not, I'm going to value my company at $500,000, and so if you're 25, gets whatever that ratio is. Yeah, Eric?
Just quickly, you know, I just want to add, you know, for a majority of the founders, you know, out there, those are not even an option. So how do you navigate those?
We'll go to the next step.
Okay.
All right. The next step is angel investors. So angel investors are typically people that have done well themselves, maybe had some startup businesses or a business, sold it, or for whatever reason, they have some discretionary money and they have a desire to invest in startups and entrepreneurs, okay? Now, it gets a little more difficult as an entrepreneur from a selling standpoint because they're not initially focused on you as an individual. They're typically, an angel investor is typically focused on opportunities where they have some personal knowledge. Okay, so a physician will typically invest in medical startups and medical tech startups. They won't invest in a high technology SaaS company doing something out of their expertise area. So that's one thing to look for with angel investors. Look for ones that are in your market or have the experience in your market. Because one, they will understand it. You won't have to do such a large education job, and that will be their area of interest, okay? So Gopher Angels is a group like that. Gopher Angels is a consortium of about 65 angel investors, all different markets, all different backgrounds. You know, from medical to technical to SaaS to, I don't know, 60 different areas almost. CPG, retail. So angel investors is the next step after friends and family if you don't. You are doing right now to get connected with angel investors. You guys are today doing one of the best things you can do, get out and network. Get out and talk to people. That's the best way to get the connections, meet the people, meet the angel investors, get introduced to the angel investors, get introduced to the angel groups that are in the area. God, for the hour before this session started, it was perfect. They said to bring physical slides, but I thought, I'm not going to need physical slides. So now angel investors, they will be interested in you like the friends and family, but that's not primary, that's secondary. They want to know what it is you're building, what it is you're going to do. They'll ask, what does your market look like? Getting there. Yeah, look at that. You faked me out. So they will start to ask more questions about the market, the competition, your team, how well-rounded is your team. If you've got a high technology company and you're not the geek, who's your geek, right? You better have a geek on staff, right? And then they will be a little more passionate about your business than a VC will, and we'll talk about that. Because they are knowledgeable subject matter experts. They typically want to help, which is a good thing. You want the help of people who have been there, done that, for example. But then they will ask you about, what are your next steps? How are you going to grow? And then you will get into the basics of a valuation discussion with them. They will start to ask, what do you think your company is worth today? What do you think it'll be worth down the road? They're looking for an exit, okay? And again, that's a difference between friends and family and an angel investor in a VC. Friends and family might be okay with you developing a lifestyle business. So one that gives you and your family income for many, many years, as long as they get some of the dividends and some of the profit out of that business, right? You get to angel investors and professional money, they're looking for an exit. They want to know what's your value today, what's your value in X number of years from now, who's going to buy you, and what multiple am I going to get? That's what they're looking for. So if you go talk with angel investors or professional money, and you don't have an exit strategy, that's going to become a very difficult conversation because they are not interested in a lifestyle business. They do not want to invest in you to grow a business to feed your family for the next 40 years because they want their money in, they want a profit, and they want to get it out to do something else with it. Maybe I can look at my screen and how am I doing that?
You're doing good.
Oh, let's talk about where your company's at. So if you are in the idea stage, you may get friends and family, and a good chance you get friends and family to invest. I have a great idea, I want to build this business, but I'm at the idea stage. You won't get an angel investor and definitely not professional money to invest. An angel investor is going to at least look for a minimum viable product. So if you've gotten far enough where you actually have a product, that'd be probably the earliest point an angel investor would invest, is you have a minimum viable product. What they would look for after that is proof of market. Do you have some customers? Are they using the product? Could be beta customers, okay? That'd be the next step. So non-paying customers, right? So you'll find some angel investors willing to invest there. If you have some customers that are paying, all right? So not only do you have your product, you've got some customers, and your customers are actually willing, they see enough value in it to pay you. That's the third level, and that'll get angel investors even more excited, right? And the further along you are in that progression, the less you're going to have to give up to get the money from the investor, because the perceived value of your company will be higher. if you're an idea stage, you might give up, don't ever give up more than 50%, but you might give up 49% for like 50 grand, right? Which might take you, money-wise, 9 months, maybe a year, but you're gonna give up a lot of money. Whereas you go with friends and family, you might only give up 10%, 20% for that same amount of money. Where am I? Sorry. Wow.
Where your company is at.
Yeah.
Different fundings.
So let's go into venture capital.
So do you want to set it here?
Here, and I can use my
Okay.
screen.
I didn't think I'd have to memorize it so well. I thought I'd be able to turn around and, oh yeah, there it is. And I've got my son in the audience, who is also a multiple serial entrepreneur. He's got 2 companies right now, and he's just about ready to sell one of them. So he's going through the exact same thing that I'm talking about right now.
If I'm here. Good.
So let's talk about venture capital a little bit, okay? Now we're talking about professional money. That's what they call it. We're not professionals, we're just people who have kind of been there. I've bought companies, sold companies, grown companies. I've failed at companies. We're just kind of people that have, some of us, been there, done that. So I wouldn't call that professional. I don't have an MBA in finance, which I think a lot of the venture capital companies have. The company we work for is basically all serial entrepreneurs. All of our investors are serial entrepreneurs. So we're all kind of been there, done that, been successful and whatnot. But when you start looking at professional money, I think probably the smallest check you should look for, or maybe even entertain getting, is 50 grand, and that's in the very low end. Typically it's 100 grand or above for initial professional money investment. We do typically 500 grand and above. But it becomes very non-personal when you get to venture capital money. The most personal is friend and family, mom and dad. Then you get an angel investor who's interested in your business, your market, and you. But then you get into professional money, okay? Now, professional money is just that. We have a pot of money that we want to invest in companies, but we're fairly agnostic into where that money goes. Okay, you may have your company, you're coming in, you say, okay, here are my competitors. I know who my competitors are, right? And in the first 2 scenarios, that works really, really well. Say you're in the med tech business, well, this company does this and this company does this, and we do that better because of this. That's your first spiel, right? You get into professional money, their money can be used anywhere. So they view your competition as not only who you directly compete in your marketplace, but where else can we use our money? So all of a sudden, your competition is not what you thought it was. It's that in addition to every other place that a VC can put their money. What they're looking at is where is the highest return in all the places they can put their money with the lowest risk. That's what they're looking at. So you've got competition now that you didn't even know you had. They will also look at a lot of things you don't necessarily think about, right? They will look at your total addressable market. What's the overall market for your product? They will do research in all the competition, what's out there. Peyton has interns working for him that do tons of research for us on competition and markets and economies and effect on economies and God knows what else. Pages and pages of stuff we read that the interns put together on your business. They learn more about your business than you thought you might ever know, right? And it becomes very arduous process to raise money from a VC. Our process, for example, we have a couple meetings, you get past a couple meetings, you get into due diligence. Well, before we go to it, let's talk about the valuation, the offer. Okay, so now we're talking about someone else who is learning your company, puts a value on your company, right? You've got a value in mind. You know, it's more than a percentage now. It's now what's the value of your company today and what you're going to make the value of that company. So you go in with a valuation in mind. Let's say you walk in with, my company's worth $5 million. Well, you start having the meetings with these VCs, they're going, no, your company's not worth $5 million because I'm looking at my return potential and what I can get and what I've obligated to my investors, the kind of return I'm going to get for the fund, and I can't give you money and value your company at $5 million. That whole calculation scenario about return to investors and where to put the money and the opportunity cost of the money has very little to do with you and the value of your company. It's totally out of your control. But they may come back and say, where you are now, maybe it's $3 million. And what I want you to take out of that is the valuation will always be a negotiation. That's what I've learned running this VC. It's always a negotiation. You both start out with your endpoints because you're both right and wrong. You know, there's no hard facts to value a startup company. It's all based on research and personal opinion and a whole bunch of other stuff. But it is a negotiation. So expect to go in talking to a VC, if you get to the point of time valuation, negotiation. You're going to bring up all the positive points. They're going to bring up all the non-positive points. And hopefully you get to a tentative agreement. Yeah?
Do you typically negotiate pre or post? Or does
Both. Yep. Pre or post money. Once you agree on a valuation, yeah.
With Gopher and Traction, just your experience in the area, are you doing much on safes or convertible notes?
Both. Yep, really both. I think Gopher is shying away from safes. I think safes is becoming a little bit passe. I think they had a bad experience with a safe a while back, so they're kind of not looking at safes too favorably anymore. But convertibles, yeah.
Can you describe what a safe is briefly?
Go for it.
Yeah, it's basically an opportunity to sort of put the valuation down the line. So it's really a more simplified version of a convertible note, which basically is debt. You initially take it on as debt, given parameters that in the future it will turn into equity, given a scenario, which is often a price round later in the future.
Yeah.
The advantage to the investor is that the cap that you agree on in the safe is typically lower than whatever the valuation will be on the next round. So you're getting more for your money at that conversion than other investors on that round.
I think what happened with Gopher Angels on the safe is that the company struggled a little bit. The next investment round was lower than anyone had anticipated. I think that's what's happened. So it's kind of, for the investor, it's kind of a unknown valuation in the future, which increases the risk, right? So you agree on the valuation. You will then get a letter of intent from the venture capital company. Letter of intent will outline what they're investing in, what the valuation is, post-funding or pre-funding. Also a list of requirements from the venture capital. Like your salary can't be higher than this, your bonuses look like this, you need the VC's approval to spend anything over 100 grand, maybe stock preferences, maybe some future warrants. So if you do really well, the VC will invest more at this predetermined valuation. Then, you go back and forth with that, you spend money with your lawyers going back and forth with that, and you get a signed LOI, letter of intent. Then the real work begins. Now you've got to do the due diligence that the VC requires.
What are the risks of starting out with a convertible note instead of a safe or any other approach?
Well, a safe is more risk for the investor, right? Convertible note, the valuation is set at a future point in time, and usually the conversion is up to the investor, not the entrepreneur. So a convertible note is really a delayed investment. So it's like you the entrepreneur, say, Mr. Investor, I'm going to let you have debt on my company for your investment. You'll get 8% return on your $500,000. And 2 years from now, if you want to convert that to equity, you can at this discounted valuation in the future. We haven't done a convertible note, have we?
We've only made straight equity investments at Traction. That being said, we would be opposed to a convertible or safe or other options, but we have not invested in one of those instruments yet.
The due diligence, to give you an idea, our due diligence document that we send the entrepreneur after the LOI signed is about 300 questions. A lot of it is document delivery. We set up a whole private secure room for document delivery, for all your incorporating documents, previous financials, your tax returns, any of your marketing materials, any of your research materials, all sorts of stuff. And what I get to do, one of my main jobs at Traction Capital, is I review all those documents for content. Like, if you have people working for you, do you have employment agreements with them saying that you own all the IP, all the intellectual property? By the way, that's very important. That if you have a startup, you have people working for you, make sure they all sign documents that say the company owns the intellectual property. Because one of the big red flags for an investor investing in your company is that down the road someone claims, well, I built that. It's mine, right? Once you get a lot of money and you're successful, people are going to come out of the woodwork and say, nope, that's mine. So that's one of the big documents we look for, is assignment of all IP to the company. Very important. Where are we?
So, other than money and a lot of questions about the business, does the investor get anything else at these stages? It sounds like at the friends and family, you get the loving support of Uncle Ted. At the venture capital or at the angel stage, maybe you get somebody that is on the same technical level as you can to bounce questions off of. How about at the professional stage?
So I'm going to try and answer that without touting Traction Capital. So in my mind, there's two types of VCs. There's money only, and then there's VCs that really want to help you grow, right? So I think I mentioned Traction Capital. It's not, I don't want to say it's derogatory, it's not a group of New York MBAs that put some money together and created a fund. Everyone at Traction Capital, all of our investors are serial entrepreneurs. All of us are there ready to help. We usually take a board seat with a limited partner that's expert in that area of that company, okay? And we help out. We'll help with finances, we'll help with networking, we'll help with growth strategies, all sorts of stuff. Our fund decided to do it that way. So that's a really good point. When you look at professional money, see what other services and value adds they bring to the table. To give you one quick example, we did our first we're fairly a new fund, a little over 12 months old. We did our first investment 15 months ago. They were doing 30 grand a month.
Less than that.
Less than that. They're doing 600 grand a month now in a little over a year.
What I tell my founder friends when they go to raise money from professional money, it's kind of a question you have to ask yourself as the entrepreneur. Do I want to get the highest valuation possible and just get a check? Or do I want to bring on an investor that really adds value? Maybe it's industry resources, maybe it's experience from their team, board seats, suite of services, you name it. But you can go out and kind of shop for different VCs based on what you think your company needs. But you might not always get that highest valuation possible from a value-add investor, because they're gonna provide more work, they're gonna do more lifting for you than, just the highest check possible, so.
Are we on the Q&A? Is that the next one,
Yeah,
or are we?
I mean, we have 10 minutes left, so.
So that's kind of the end of my talk. So questions, please.
So when you're in the early, pre-seed stage and you're raising on safes, do you have to have a definitive start and end for your raise? Like, we're raising this much on these terms and it ends on this date? It kind of feels to me like you can kind of raise on safes until you're ready to do your seed round or a more official round. You know what I'm asking?
Go ahead.
Well, I'm seeing more companies do that, actually. I don't have much more to elaborate other than, I do see that from time to time. People just kind of doing.
Certainly, most VCs, or most investors want to have a defined period, usually 90 days. It'd be pretty unusual for them to say, you can raise money at this valuation or under these terms forever until you see your seed.
Right, so you want to do a definitive round of raising on safes and then be done.
Yeah, I think that's what, if there's a lead investor on the safes, that's what they'll probably say, we don't want you selling at this, on these terms, 2 years down the road.
Sure, but what I have seen though too are safes that, so I recently was talking to a founder who's raising $1.5 million safe, and they're getting a bunch of smaller checks and closing on that. They don't have a lead, but they've closed on about 700 of their $1.5 million, and it's been a longer process to raise that. So you're right, you wouldn't in perpetuity until you get to a Series C, just continue to raise on the same terms. But that is something that you're saying is maybe a more drawn out process.
And I myself have raised on a lot of convertible notes that way. A little bit longer time frames, primarily because we gotta be careful too to see where your valuation caps are and how they convert. Because you wanna make sure, if you have multiple rounds of convertibles or that, you have to make sure how you stack them and make sure that they're not dilutive to each other. at the
You don't want
time.
somebody putting money in a year from now, valuation cap of 5, if you're out raising money.
It depends on how they convert, right? If the conversion activity happens in the future, really it'll be dilutive to the founders, not necessarily at a worse position to the convertible note holder. So you can use time, but you also have to think depending on your conversion work, there's probably gonna be a cap and a discount. So you don't wanna raise too much where you end up in a very bad situation on that.
Yeah.
So it's kind of this, in my mind, it's a healthy financial balance of time, percentage, how it converts, how it dilutes or doesn't, when all the convertibles convert, and when that will happen and what the cap valuation is.
Yeah, like the scenario we're in now is we went through an accelerator about a year ago, we got $75,000 for 3%, but now we're doing our pre-seed raise, we're trying to get $1.5 million and on stage. So I think what we're feeling is we should just open it, close it, have a definitive date, and then get back to work, not just leave it open.
I mean, for my best and best,
Yeah.
you can, but the world is the world.
But early on, if you just needed a check early on, you kind of have, don't you have 3 years before your safes need to convert, something like that?
Typical time frame.
2 or 3 years. 2 or 3 years we see, yeah.
So early on, if you just need a little bit of money, you can get a safe, you can get another one a few months later, but then eventually you should have a set date for closing that.
Well, you've said pluralized safes every time. You gotta be very, very careful that the best is multiple documents, but all the same terms,
Yeah.
right? Worst case scenario is you do some safes, you move forward with your company, valuation goes down, now you're doing new safes at a lower valuation than you did your original ones. They're not gonna be happy,
Right.
right?
Yep. Okay, that makes sense.
Any other? Don, you good?
No, so my comment would be, if you keep elongating it, you're not focusing on your business.
Right.
Right? So a lot of investors aren't gonna want you to keep investing, like when fundraising over and over. I've had the company for 10 years. My company, I'm based out of San Francisco, Silicon Valley, maybe relationships out there. But, I bootstrapped mine and we're a $51 million revenue base right now with no investments at all. Right? And there's a lot of ways to do it that I've talked to people about, which is negative cash conversion cycle. for you to then service them. And don't pay your vendors till after you get paid. Especially, like I've got a $42 billion vendor who is dying to be in my niche, so I never pay him until I get paid millions of dollars, right? So even though my net 45 or my net 60 with them is net 60, sometimes it becomes net 90 or 120 because my client's not paying me, right? So, I mean, Dell and Amazon basically grew their company on negative cash conversion cycles.
But that reminds me of something else. Fundraising. Fundraising is the worst job you'll ever do in your whole life. It is. Because you've got, first off, you're not focusing on your company, right? Either that, even if you're working 120 hours a week, you're still not focusing on your company. And you got all these people telling you what your company's worth, right? What the hell do they know? But you got to argue with them. You got to make your pitch, and it's a terrible. I hate it. I hate it. I'm glad I'm past it.
Is there any industries you target?
Me, Gopher Angel, Traction Capital.
Any of the above?
Gopher Angels is pretty open to any market. It's tough to get in there. They see about 60 opportunities. They meet every 2 months. They see 60 opportunities within that 2 months, and they only have room for 8 presenters. So it's pretty competitive to get in there. Traction Capital, we are agnostic. The only things we will not invest in is brick and mortar retail and med tech. Other than that, we're very agnostic in what we invest in.
What's your appetite for global opportunities?
Traction Capital is Minnesota Midwest only.
Okay.
Gopher Angels, I believe they're continental U.S. only, I'm pretty sure.
Okay.
Got 2 minutes left. Any more questions?
I missed that last, what you don't invest in, brick and mortar, and what else?
MedTech.
MedTech, okay.
Yep, that's Traction Capital. Gopher Angels invests a lot in MedTech. Yep.
I'll just add, I don't know if Groove Capital was mentioned, but they're an angel network, just like Gopher Angels, so I recommend looking them up.
They are very simple. They write smaller checks. You're right, thank you. Groove Capital, very pervasive in the startup community. Reed's done a great job of, and I've known Reed for 15 years, I don't know. Whenever he came on the scene, I've known Reed. And their checks are typically about 100 grand. Startup checks, they Thompson House says first check. I think that's what they say. So, Groove Capital. Groove, yep, Groove Capital.
So, and also give a shout out to Tundra Ventures that.
Yes, Tundra just came on the scene investing in founders of color and disadvantaged and women-owned, I believe. Those are 3 categories. Thank you.
Yeah, in addition to that, the Brown Venture Group as well.
Brown, yes.
Yeah, I
Yep.
think, one of the LPs is also, Best Buy, I think, one of the LPs. So if you're looking at, a tailored, something that is specifically for minority or black and brown type venture, and I think the agnostic is agnostic.
Agnostic, yep, in there.
Yeah, they have, and their approach, I think they both do U.S. and also are now venturing, basically exploring opportunities globally.
One other thing I want to mention real quick, you just reminded me of that because I talked a lot with the Brown guys about this. Minnesota Angel Tax Credit. It's out of money this year, but it might get refunded with the Omni bill coming in. But it's very advantageous for you as an entrepreneur to get certified for the Minnesota Angel Tax Credit. It's run by Deed, and what it is, the legislators put so much money aside every year for this Angel Tax Credit, and if you are a Minnesota company with Minnesota employees, anyone who invests in your company, if you're qualified, gets 25% of that investment back as a tax credit.
I think the MSP did a $50 million fund too, right? MSP?
Greater MSP, but that's different than the Minnesota Angel Tax Credit. I'm not familiar with that yet, so I apologize. But the Minnesota Angel Tax Credit, I mean, all of a sudden your investor is seeing a 25%, and it's actually a refund. It's not a write-off, it's actually a refund. They get it off their taxes. State income tax, yes. If your investor is out of state, they can apply and they'll get a check. So your investor can be out of state Minnesota. But your company, there's like 6 qualifications for you to qualify as a business. Be in Minnesota, pay your employees above average wage is part of it. Your employees are in Minnesota and things like that. We're out of time. Thank you very much. Thanks for attending. I hope it was informative, and I hope I didn't talk your ears off too much.
Eric?